So go to mypatriotsupply.com today. That's mypatriotsupply.com.
Broadcasting from the Kanowski-Bresney studios comes the radio medium Laura Lee Show.
I feel like you had to let him go.
Yes, it is. He was on life support.
You've taken on the burden for his passing. Is that true?
That is right.
There's something to do with a Barbie doll.
He used to stick the old school Barbie dolls in the cake.
Oh my God, you're giving me goosebumps right now.
The radio medium Laura Lee Show. Tune into your spirit every Tuesday at 4 p.m.
Hey parents, you don't need the latest gizmo, slang, or clothes to be a perfect parent, because kids in foster care don't need perfection. They need you. For more information on how you can adopt, go to adoptuskids.org. A public service announcement from the U.S. Department of Health and Human Services, Adopt Us Kids, and the Ad Council.
You're tuned in to Money Matters Boston, 1120 AM WBNW. This is the Money Matters Radio Network, WBNW 1120 AM and W275CM FM, Concord, Boston. The Money Matters Radio Network.
October 24th is National Food Day, a perfect time to celebrate fresh, local food right here in Massachusetts. Fall harvest season is in full swing with crisp apples, sweet pears, pumpkins, squash, cranberries, and hearty root vegetables at your neighborhood farmers market. Markets are still open, so grab your bag. Support local farmers and bring home the flavors of autumn. Sponsored by Mass Farmers Markets, helping grow farmers markets across the state. Find your local market at massfarmersmarkets.org.
Mark Vonner is the CEO of Veterans Development Corporation. Mark is a career military man, having served for nearly 20 years, and we are so thrilled to have him and his company as a key partner and the presenting sponsor of the DAV 5K Boston. Mark comes from a proud military family, including his father Victor and his brother Timmy. Mark talks often about how serving his country was one of the greatest achievements of his life, and that's one of the key reasons that he chooses to give back to this special community. Mark is honored to continue his legacy that his father started when he built Veterans Development Corporation. Working to help many disabled veterans and their families has become a lifelong goal for Mark, and it's why he's taken the time to fully support the DAV Department of Massachusetts. You can join Mark Vonner and Veterans Development Corporation and help our great American heroes today by making a donation or becoming a sponsor. Simply visit dav5k.boston. That's dav5k.boston.
Hey, listen, are you a 50-year-old person looking for term life insurance? Then you need to talk to Bob. Bob specializes in helping people find $1 million or more of term life insurance for a couple of $100 a month. Look, you need to know there's a price war in the term life insurance business, and you may be paying too much. Call Bob, and he'll shop and see how much money he can save you. Look, this could be the last term life insurance policy you ever have. Your rates are guaranteed for the next 20 years. That's right, guaranteed level rates for the next 20 years. And if you're a smoker or your health is not perfect, Bob has great rates for you too. So for $1 million of term life insurance coverage for a couple of $100 a month, call Bob right now. 800-965-7987. 800-965-7987. 800-965-7987. That's 800-965-7987. Paid for by Term Direct.
Hi, this is Chuck and Mike from the Armstrong Advisory Group, and we've got a guide available this month titled Understanding Required Minimum Distributions. Mike, a lot of changes in the RMD landscape. When do people have to take RMDs from either IRAs or Roths?
How old are you?
Me personally?
So this does start changing now. It is currently 73 for a lot of folks. For some younger folks, it's actually now going to be 75 years old for your traditional IRAs and 401ks. And so that started at 70 and a half just a few years ago. And so this is a new set of rules for a lot of people.
When you look at how the penalty situation has evolved, this is one area that's actually gotten a little bit more lenient in recent years. And so that's something where if you are new to RMDs, there are some incentives if you've missed one to get that squared away as soon as possible.
There are, but, key takeaway. Understand these rules and don't miss your required minimum distribution, because there are still penalties for something that, again, is completely avoidable. Yes, the penalties used to be bigger. They are less less stringent now and a bit smaller, but it is still unnecessary extra taxes and fees that you will end up paying if you do miss your required minimum distribution. So get our guide and learn a little bit more about how all of this works.
Folks, the guide is titled Understanding Required Minimum Distributions, and there are two ways that you can request it. The first is by calling 800-393-4001. The second is by visiting armstrongadvisory.com. Again, that number is 800-393-4001, or you can request it online at armstrongadvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services.
This is Michael Valila, Adjutant of the Disabled American Veterans Department of Massachusetts. We pride ourselves on being able to support veterans in their time of greatest need, ensuring they receive the protections they deserve. For over 100 years, the DAV of Massachusetts has helped thousands of veterans with housing, transportation, and medical assistance, and you can help too. Please visit dav5k.boston and make a donation today. That's dav5k.boston.
The Financial Exchange is produced by Money Matters Radio and is hosted by employees of the Armstrong Advisory Group, a registered investment advisor. All opinions expressed are solely those of the hosts, do not reflect the opinions of Armstrong Advisory or anyone else. Investments can lose money. This program does not offer any specific financial or investment advice. Please consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong Advisory and the advertisers heard on this program do not endorse each other or their services. Armstrong and Money Matters Radio do not compensate each other for referrals and are not affiliated. This is the Financial Exchange with Mike Armstrong and Paul Lane. Your exclusive look at business and financial news affecting your day, your city, your world. Stay informed and up to date about economic and market trends, plus breaking business news every day. The Financial Exchange is a proud partner of the Disabled American Veterans Department of Massachusetts. Help us support our great American heroes by visiting dav5k.boston and making a donation today. This is the Financial Exchange with Mike Armstrong and Paul Lane.
Good morning, happy Friday. Welcome back to the Financial Exchange? The old Financial Exchange.
Been one of those weeks.
Welcome back to the Financial Exchange. It's Mike, Paul, and Tucker with you on before even 9:30 a.m. started out as a volatile day. We'll be talking about markets and the bout of volatility we've been experiencing since last Friday. We'll be getting into next week's big announcements that are coming up. So taking a look at the earnings calendar for next week. This week was all about the big banks. Next week we will be kicking off some other large companies, including Netflix. So let's take a peek here. Monday, nobody important ever reports earnings. Sorry to Steel Dynamics. Not that you're not important, but you're not very big. Netflix reports after the bell on Tuesday. GE Aerospace and Coca-Cola, as well as Philip Morris and Raytheon, all reporting before the bell on Tuesday. Wednesday, we'll be hearing from Tesla after the bell. IBM, SAP, all reporting after the bell. Thermo Fisher, AT&T reporting before the bell, as well as GE Vernova. Remember that GE is now 3 separate companies. T-Mobile going before the bell on Thursday. Intel after the bell on Thursday. So a few big names going out there. I think we'll also have the CPI release, next Thursday as well, Tucker?
24th.
The 24th, which is next Friday, rather. That's an important one. One, because the government's shut down. It's the only government statistics we're going to be getting until the government reopens. It also will be helping to determine inflation adjustments for Social Security next year, so one that people will be keeping an eye on. Big questions about that government shutdown and what sort of data we will be able to get, but when we talk about, those monthly jobs reports that we talk about thoroughly every month, the collection period for them is mid-month. So when we talk about the September jobs report that was supposed to be released the first Friday of October, The data gathering period is mid-September. Right now is the data gathering period for the October jobs report. Nobody's working, so they can't gather the data, meaning even if they're back in the office on November 1st, I find it unlikely that we would get to the October jobs report. So we'll see, but we're entering now day 17 of the government shutdown, and I have to say, still seems like very little pressure to reopen things, although, what's happening behind closed doors is always an open question. But I don't see people freaking out about TSA lines or canceled flights or any of that stuff to this point. It has not been a story we've covered.
Yeah, I wonder when the camel's back, what's the straw that breaks the camel's back in terms of the TSA? Like, when do they, how many days is it now?
It's been 17.
Just said that.
I know.
He wasn't listening. Important caveat.
It's also October 17th.
Yeah.
Chuck
had to point this out to us. Like, we were doing all the math, and he was like, guys, it started on October 1st. Now it's the 13th. It's pretty easy math here.
21 days, 3 weeks of no pay, you'd think that would start to rankle people.
We'll see. We again have not seen big impacts. I would imagine at some of the regional airports where even one call out can really dramatically affect flights. So, if you're talking about flying out of TF Green or Manchester, I'd be interested. By the way, you can text us if you do fly out of those places, 617-362-1385. But, when we talk about the Portsmouth, New Hampshire airport, or Portland, Maine, or Manchester, New Hampshire, Worcester, Providence, if you're seeing some slowdowns there, I'd be interested to hear. But out of the big guys, we have not been hearing it, and many airline CEOs have been saying no, it hasn't been a problem yet. As far as markets go, we've had a volatile week here. We kicked off the volatility on Friday of last week over the announcement on tariffs regarding China. That was following an announcement on rare earth restrictions from China. Since then, the focus has shifted, and I've come around to Chuck's way of thinking here, which, yes, the China tariffs were what kicked off this market sell-off, but apparently the markets seemed poised for something regardless of what the announcement was, because the volatility has continued even though the concern about China and U.S. tariffs has dissipated. Right? Both presidents have said, yes, we are still going to meet in South Korea in a couple of weeks. The president just this morning was saying that 100% tariffs are not sustainable for the long term. So there's been a lot of conciliatory remarks, and yet markets have been bouncing all over the place. As I mentioned in very early trading, I think this morning around 7 a.m., you had futures off by more than 1%. Markets have made their way back positive, but the VIX has been elevated. A lot of things are expressing some concern about where this market has gone to. I think, to me, there's three categories of news stories that are concerning investors. One is tariffs, U.S.-China relations, and rare earths and everything that has to go with it. Two is artificial intelligence. Is it the dot-com bubble all over again? Right. Everyone's making the comparisons. Three is the private credit market, and there's three questions around that piece. It's how many loans were taken by companies that might be over-lent to or actively defrauding their lenders. Who issued those loans?
How big?
How big are those loans that were issued, and who now owns the repackaged loans? Because, again, what does Jefferies or any other investment bank do when they issue these things? They cobble them all together into a collateralized loan obligation and sell it off to all different investors. So who owns it? And I think everybody is now searching this stuff in a way that they weren't a few weeks ago. And I'm just going to go ahead and toot our own horn for a moment. The first time that we brought up this situation was all the way back on September 29th. That was the first record I have of a email from Tucker on this subject of the First Brands collapse and what it might mean. And immediately, where did our minds go, Paul? It was, is this the tip of the iceberg, the canary in the coal mine of the private credit situation that has gotten so built up over the last few years, and will you see the spillover? To me, that's the only question that matters right now. The other ones can take a back seat. We won't know about the payoff on artificial intelligence for several years. And so we can guess as to whether or not it's a bubble. We can talk about that. But until either earnings start shrinking or companies start seeing real revenue generated from the AI build-out that's being put out there, I don't think we have a firm answer on it.
I keep wondering, how big this could be. Like even if it was massive in scale.
How big what could be? AI?
No. Forgetting AI, the private credit issues that we're talking about here. It's like it is reminiscent. I guess Chuck already made this point, so I'm stealing his thunder a little bit or copying him.
Don't credit him.
Is that
he's not here to take credit.
The Silicon Valley Bank scenario is eerily similar. We sat here in this program and talked about if this is bigger spread, this is problematic.
March 2023, Silicon Valley Bank gets dragged out over the weekend. Investors get bailed out. You have two other banks, I think it was, that
First Republic also.
Yep, that get the same issue. And the question that everyone was asking themselves is this going to lead to a run on regional banks?
Right.
Are there other regional banks out there who have the same problem of duration that's going to sink them? Many regional banks took a massive hit, and lo and behold, a few months later, we turn around and say, actually, no, this was pretty much just a problem with those guys.
To be fair, the Federal Reserve stepped in and really backstopped that thing. If they didn't, then who knows what would have happened. That was, to credit them, that was a tremendous move to really stem the tides there.
In a very big way.
And it's a different situation here when you're dealing with private credit markets. But even if this spills over to regional banks, not to be so biased like the S&P 500, but it is so much of what we deal with on a daily basis and in client investment portfolios.
Sure.
Like many individual investors listening to this program have likely very limited exposure to regional banks within their portfolio.
So let's take a quick break. When we come back, I want to continue this conversation because to me, the volatility we've seen around insurers and regional banks, which we will talk about, is not the biggest story when it comes to all of this. So let's take a quick break and more talk on private credit, who owns it, where investors are sniffing out the rot, and what it might mean next on the Financial Exchange.
Text us 617-362-1385 with your comments and questions about today's show, and let us know what you think about the stories we're covering. This is the Financial Exchange Radio Network. New Englanders love the Caribbean, and now there's a Caribbean travel channel available for you to learn all about Caribbean culture while you're planning your next trip to your favorite island. The TravelShareIt.com marketplace is loaded with information about the arts, festivals, food, and music throughout the Caribbean, and is an interactive website featuring daily travel deals to any island of your choice. Book your next Caribbean vacation on the most comprehensive travel channel for the islands, TravelShareIt.com. That's TravelShareIt.com.
Hi, I'm Michael Valila, Adjutant of the Disabled American Veterans Department of Massachusetts. The DAV of Massachusetts provides thousands of hours of voluntary services at our VA medical centers and soldiers' homes and is the only DAV department in the country to lead a veterans housing initiative for both single veterans and those with families. These programs are critical to serving our veterans in their time of need. You can help our great American heroes by making a donation today. Please visit dav5k.boston. That's dav5k.boston.
Mark Vonner is the CEO of Veterans Development Corporation. Mark faithfully served his country from 1981 to 1984, and we're thrilled to have him as a partner and presenting sponsor of the DAV 5K Boston. Mark comes from a proud military family that includes his father Victor and brother Timmy. Mark talks often about how serving his country was one of the greatest achievements of his life, and it's one of the main reasons he chooses to give back to this special community. Mark is honored to continue the legacy that his father started when he built Veterans Development Corporation. Working to help many disabled veterans and their families has become a lifelong goal for Mark, and it's why he's taken the time to fully support the Disabled American Veterans Department of Massachusetts. You can join Mark and help our great American heroes today by making a donation to support the DAV Department of Massachusetts. Please visit dav5k.boston. That's dav5k.boston.
Cushing & Dolan want to help you avoid costly mistakes when it comes to gifting assets to your children. Their brand new guide, Making the Most of Gifting Assets, shares crucial strategies to help you protect your legacy and your family. Many people think gifting is always a good thing, but if it's done the wrong way, it can create real headaches. Even well-intentioned gifts can cause complications if your children are dealing with financial pressure or legal issues like a divorce. The guide also explains how a major gift, like a home or vacation property, could come with hidden tax consequences that may impact your entire estate plan. Before you make any big moves, arm yourself with the facts in this new guide from Cushing & Dolan. Call 866-848-5699 right now to get your copy. That's 866-848-5699. or request it online at LegalExchangeShow.com. That's LegalExchangeShow.com. The proceeding was paid for, and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and/or Armstrong Advisory may contact you offering legal or investment services. Cushing & Dolan and Armstrong Advisory do not endorse each other and are not affiliated.
Hey, listen, are you a 50-year-old person looking for term life insurance? Then you need to talk to Bob. Bob specializes in helping people find $1 million or more of term life insurance for a couple of $100 a month. Look, you need to know there's a price war in the term life insurance business, and you may be paying too much. Call Bob, and he'll shop and see how much money he can save you. Look, this could be the last term life insurance policy you ever have. Your rates are guaranteed for the next 20 years. That's right, guaranteed level rates for the next 20 years. And if you're a smoker or your health is not perfect, Bob has great rates for you too. So for $1 million of term life insurance coverage for a couple of $100 a month, call Bob right now. 800-965-7987. 800-965-7987. 800-965-7987. That's 800-965-7987. Paid for by Term Direct.
Find daily interviews and full shows of the Financial Exchange on our YouTube page. Subscribe to our page and get caught up on anything and everything you might have missed. This is the Financial Exchange Radio Network.
This segment of the Financial Exchange is brought to you by the U.S. Virgin Islands Department of Tourism. Looking for a getaway that's easy, warm, and unforgettable? Discover the magic of the U.S. Virgin Islands, St. Croix, St. Thomas, and St. John. Just a short flight from New England with no passport needed and no money to exchange. Soak up the sun, stroll along white sand beaches, and feel the rhythm of the heartbeat of the islands. The USVI is America's Caribbean paradise. Plan your fall escape now and visit usvi.com. That's visit usvi.com.
All right, so let's go back to this First Brand story because it has been pretty intriguing. Tricolor has as well, but I want to talk about the fraud that's being alleged by First Brands, which is effectively all different types of lending that they were doing, and it's tough to say exactly where the fraud is occurring, but even those who are running the bankruptcy have been asked, like, can you account for this money that's supposed to be on the balance sheet? And the answer has been no. Mm-hmm. And so there's some more shoes to drop on there. There's some difficult questions being asked, especially of Jefferies, who originated a lot of this lending for a few different reasons. One, because they were making these traditional loans to them, and they were also, on the other side of their business, helping out with the vendor financing. And that seems to be the piece that a lot of people missed here, was that, oh yeah, you're taking out these traditional loans and look at this great business model, but you have all these kind of hidden vendor financing deals going on in the background too, which leads to a lot more debt than was publicly known. And the Wall Street Journal at least, put together a piece showing how Jefferies had exposure to both of those sides through different units of their bank. And again, the question on Jefferies is, if anyone should have known, shouldn't it have been you guys? So, again, they've pulled some investor presentations where Jefferies, for example, estimated the total debt to be around $5 billion. We know that it's now approximately double that.
Right.
So big questions there. Again, allegations of fraud and just some curiosities here with this bankruptcy. So then the next question was, okay, Jefferies, you had a big hand in originating this. Now who owns all this stuff that you packaged together and sold? And the answer seems to be UBS and a few, even JP Morgan had some. No, JP Morgan was just Tricolor.
Just Tricolor.
Yeah. So a few big banks, but largely also some smaller banks and insurance companies. Yesterday, the regional banking index sold off by about 6%. I haven't looked today. The insurance sector index dropped by about 3% on this news. In particular, a few regional banks that, again, unless you bank with them, raise your hand if you're familiar with Zions Bank Corp or Western Alliance.
I've heard of them,
yeah,
only because of our worlds.
You don't probably know them a whole lot. And taking a look at this stuff, their preferred shares, both of these banks had some of the worst days since April of 2024 on this sort of news. So, Paul, you asked an intriguing question to me, which is, okay, cool, Mike, interesting, but
should our listeners
who
care?
Gives a darn?
Right.
Who gives a darn? Because unless you are a real active investor who's out there picking individual regional banks, should you care? It's not moving markets today in the negative, and none of these things even make it into the top 10 of any of the indices. And I come at it from a different perspective. If this is isolated, if it's concentrated in a couple companies that perpetuated fraud, then it's probably not a problem.
Yep.
If instead what this causes is every investment bank and private lender to go out there and to take a good hard look at their loans and start asking tougher questions of their borrowers, and it turns out that there's something more systemic here, then what that will ultimately lead to is all of these lenders pulling way back on lending.
Sure.
And one of the key funding sources for the biggest thing that has mattered to markets this year, artificial intelligence, is private credit lenders. They've been lending and investing approximately $50 billion a month into all sorts of different areas of artificial intelligence build-out. And so without that cash flow, to me, there's some big questions about what this market can actually stand upon. Yes, Google is still going to be pouring their money into there. But again, even a marginal drop in investment on these different areas, I think could lead to some pretty dramatic effects. So that's where I care about this. I do care about the regional banks too, and I don't want to see a bunch of them go under. That can be pretty systemic. But I think, honestly, the comparison that you were making before of 2 years ago, Paul, with Silicon Valley Bank is probably the appropriate one, which is to say, we don't know if this is isolated or systemic. There's probably not an easy way for the Fed to step in and quash it because of the type of lending that this is. They don't oversee private credit. It's not banking. It's really not an area that they are into. And so we need time to figure out, is this isolated or is it systemic? But when you have two failures this close together in a related industry, I start to ask questions.
I'm going to rebuttal your sentiment a little bit in that I get the further trickle down of impacts from this credit issue could become problematic, and here's why. You made the key point with it could cause scrutiny on these companies to lend less often than they were previously, which was at a absolutely rampant pace. But I wouldn't have it snowball all the way, I'm going to call it, up to some of the major tech hyperscalers, is in terms of that's the type of financing that they would pull away from. I think where the problem could lie is that they may pull away from the financing that so much of the small to mid-market businesses in this country rely on for financing, and that would have a detrimental impact to those. And that's why, not to say I don't care, because that is important. We talked about on the show the other day where, small businesses employ half of this country, and a significant percentage of the lending for these businesses comes from this private credit area. So that's important. But then again, from an individual stock ownership standpoint, for the retiree out there in their 401k, they probably don't have exposure. I think it would be more of a macroeconomic concern that I would have, that all of a sudden small and mid-sized businesses that are already getting beaten up by all the tariffs that are in place year to date also have difficulty getting as much lending, rather than taking your worst case scenario of, all of a sudden, Oracle or whomever, maybe not them for the hyperscalers, maybe CoreWeave, something down the chain a little bit, don't get their financing for the AI build out. But it's an interesting discussion and thought exercise to have.
Yeah, we'll see where the spillover is. But clearly, investors over the last couple of days sniffing out a few areas. One is regional banks, two is insurers. And again, why they have this exposure is pretty simple. I mean, both of these institutions take in a boatload of cash from their customers and then have all sorts of potential liabilities to pay out. And so if you're taking, a $1,500 insurance premium from the Lane family on their auto policies, you can take it, you can, invest it at the Fed and get some interest, you can go buy treasuries and get some interest, or if you can convince your board and your shareholders, you can go buy a basket of, collateralized loan obligations, juice your return, and boost your profits and or offer a lower premium to your customers.
Charlie,
so perfect on all fronts until it blows up in your face.
Charlie Munger has this quote that smart men go broke from ladies, liquor, and leverage. And the leverage one, it's like, how often does this come up, Mike? This is CLOs. We did this before with CMOs, and it's like the package of stuff. It's so eerily reminiscent how history repeats itself, where you get over your skis and overborrow and overextend, and something blows up.
That is the business cycle, Paul. Quick break. Wall Street Watch coming up next.
Like us on Facebook and follow us on Twitter @TFE Show. Breaking business news is always first, right here on the Financial Exchange Radio Network.
Sometimes we know what's next. Other times, it's impossible to know. Life can change in an instant. Don't be caught standing by the next time someone's heart stops. Knowing CPR gives you the ability to act and takes you from bystander to lifesaver. CPR is a life-saving skill. Join the nation of lifesavers today by learning CPR at heart.org/nation. National support for CPR education provided by Elevance Health Foundation.
It happens all over Massachusetts.
Can you tie my shoes?
In every home and every community.
Be careful on your bike.
Learning can happen anytime, anywhere.
We'll see you at practice this weekend.
And no matter how learning takes place in your family's life, DESE is there as your partner. The Massachusetts Department of Elementary and Secondary Education. Never stop learning. Find out more at mass.gov/back-to-school.
Sponsored by the Massachusetts Department for Elementary and Secondary Education.
New Englanders love the Caribbean, and now there's a Caribbean travel channel available for you to learn all about Caribbean culture while you're planning your next trip to your favorite island. The TravelShareIt.com marketplace is loaded with information about the arts, festivals, food, and music throughout the Caribbean, and is an interactive website featuring daily travel deals to any island of your choice. Book your next Caribbean vacation on the most comprehensive travel channel for the islands, TravelShareIt.com. That's TravelShareIt.com. Cushing & Dolan know that gifting assets can be one of the most emotional and challenging parts of estate planning. Their new guide, Making the Most of Gifting Assets, can help you learn what to consider before making a major gift, like your primary home or a vacation property, and avoid unintended tax problems. Call 866-848-5699 to get your copy, or request it online at legalexchangeshow.com. The proceeding was paid for and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing & Dolan and Armstrong Advisory do not endorse each other and are not affiliated.
Hi, this is Mike Armstrong from the Armstrong Advisory Group. If you're approaching your 70s, you might be thinking about slowing it down, but the IRS is just getting started. Required minimum distributions, or RMDs, kick in starting at age 73. And if you were born in 1960 or later, that number jumps to 75. RMDs are more than just a box to check. They can impact your taxes, your income plan, and even what you leave to your heirs. If not done properly, it could mean big penalties, but getting them right might help keep your money working for you. Our latest guide, Understanding RMDs, breaks down how they work, when to take them, and strategies that may make them less of a tax headache and more of a financial opportunity. Request your copy today by calling 800-393-4001 or by visiting ArmstrongAdvisory.com. That number again is 800-393-4001 or ArmstrongAdvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services.
This is Tucker Silva of the Financial Exchange Show, and I'm joined today by estate planning attorney Todd Lutzke, a partner with the law firm of Cushing & Dolan, with their master's in taxation. And today we're talking about the implications of gifting assets away. Todd, if you're trying to protect your assets from the cost of long-term care expenses, what are the risks in giving your assets to a child rather than transferring them to an irrevocable trust?
Yeah, it's a very big difference, right? These irrevocable trusts that we do for Medicaid purposes, first and foremost, are incomplete gifts. So you're not actually making a gift at all when you put it into these trusts. But if you give it to a child, now you've made a completed gift. So, for example, if I gave away my house, and people do it, right? You are giving away the built-in gain in that house. You now don't have any control over the house. You can't sell it and buy another one if you want to move. You need the kid's permission for all of that. Plus, if you never sell it and you die, you've trapped the built-in gain for the kids. When they go to sell it, they're going to have to pay capital gains tax. Whereas if you keep it, you can control it, get a step up in basis for the kids when they die, and still protect it from the nursing home through the trust. Either way, it's going to take 5 years. But gifting isn't always the answer.
Educate yourself about the implications of gifting your assets away. Request your free copy of Todd's brand new guide called Making the Most of Gifting Assets right now by calling 866-848-5699. That's 866-848-5699. Or you can request a copy on their website, legalexchangeshow.com.
The proceeding was paid for and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing and Armstrong do not endorse each other and are not affiliated. Time now for Wall Street Watch. A complete look at what's moving markets so far today, right here on the Financial Exchange Radio Network.
Well, it's been a bumpy ride for markets to this point as investors weigh regional bank concerns. This comes after Zions Bancorp said it would take a large loss, accusing some borrowers of fraud. Right now, the Dow is up by about 0.25% or 126 points. S&P 500 is up 0.1% or 8 points higher. NASDAQ up 0.1% or 22 points higher. Russell 2000 is down about 0.3%. 10-year Treasury yield is up 4 basis points at 4.016%. And crude oil mostly flat, dipping lower, trading at $57.38 a barrel. Well, after yesterday's 10% plunge, shares in Jefferies bouncing back 6% today. The bank has recently faced questions about its ties to the First Brands bankruptcy. However, Oppenheimer upgraded the stock to outperform, with the firm said Jefferies' exposure to First Brands is very limited. Meanwhile, another big financial name, American Express, beat third quarter expectations and raised its full-year guidance. The credit card company reported a jump in profit and revenue where card holders spent more and card fees grew. Amex shares are rising almost 5%. Elsewhere, shares in Ozempic maker Novo Nordisk falling over 3% after President Trump said the cost of the weight loss drug could be $150 or much lower than it is now. Micron Technology down by about 1% after Reuters reported that the chip maker would exit the server chips business in China. Railroad operator CSX is up 2% after it posted better than expected third quarter earnings. And Oracle stock pulling back after yesterday's rally by 6% today. Yesterday, Oracle confirmed a cloud computing deal with Meta. I'm Tucker Silva, and that is Wall Street Watch.
Paul, most Americans are falling behind in saving for retirement. I've heard this story again before, but you do financial planning, I would guess, every day, just about. So you and I have both run into instances where we are working with somebody on their financial plan, and they're approaching retirement, and things don't work. Mm-hmm. So we always have a bunch of levers to pull. What are the levers that you pull if you are falling behind on putting things together for retirement, saving for that bucket?
One, which is not the most appealing, is you continue to work longer than you would have wanted to, which isn't the first one that you want to start with.
It's always a tough pill to swallow, yeah.
It is, yeah. Otherwise, there are some instances where I'm working with clients, particularly what's so important about this is doing it before it becomes an issue. You could kind of make the parallel to Social Security Trust, which is mentioned in this article. It's projected to run on 2033. Gee, it would be so smart if we took measures today to try and curb that potential issue. That's a separate deal. We all know about that. But specific to an individual out there, the sooner that you address that shortfall, the easier it is to potentially resolve that issue rather than saying, gee, I'm 64 or 65 years old, it's time to pony up and save more. What oftentimes I'll look at with clients is, let's say you get past the college tuition years for your kids and you're starting to phase into, call it your late 50s, early 60s. That is that point in time where you can really turn on the saving switch for a lot of people. You're at the peak of your earnings power from an income perspective. You don't have the big liability of a tuition payment. That's the time to start to gear up and get ready to go.
Yeah, I'll be honest, like the working extra and cutting expenses piece, they're the most impactful ones you can do, but they are also the toughest ones to get buy-in to.
30
right?
years
I
of
mean,
working your butt off, or 40 years, and then you have to cut expenses.
You know, the one that gets underestimated in my mind, we're oftentimes talking to people who have been in stressful, high-power jobs for a long period of time. But pulling off a few years of working for even a third of what that person was pulling in before in a very low-stress type environment, it has a lot of impact.
It does.
You know, like, that's one where I think people sometimes undervalue, or as the author of this piece puts in, there might be some embarrassment or shame in doing that type of work. And I guess I've seen it, and I'm not here to judge psychology, but like I know people who have gone from, working in a six-figure job to working part-time at Home Depot, and one, really enjoy the work a fair bit, and then two, have this bucket of money that they pull in that really defrays the need for Social Security or other things that they're able to put off for longer. But I think, as we frequently come back to from the Armstrong Advisory Group on all of this, it's about knowing. Like, that's the first step in the process, because if you don't know how much you can afford to spend or how much you need to save every year to get to a comfortable place, then it's all kind of a moot point, right? You can't make these goals and objectives without having some semblance of an idea of how much you need to get to.
Yeah, or what is your baseline? I can't tell you, Mike, and you probably see the same thing, how many people have no idea what they spend on a monthly basis. I would say upwards of 70 or 80% of people we meet with initially don't have an idea what their baseline is.
Right. So these are important considerations, and the fact of the matter is, you might have a really firm grasp on the budget. You might have a really firm grasp on the investment strategy and portfolio and what your returns have been. Ultimately, though, to make your financial plan successful, you have to have a sense for where you're trying to get to and what it's going to take to get there. How much can I spend? How much do I need to make? How long do I need to work? And what is my real number? Like, what number do I need to get to before I can comfortably hang it up? And it's different for every household. If you're trying to answer that question, that is what we do at the Armstrong Advisory Group day in and day out, is help people assess what that magic number is going to be to make their plans work in retirement. Give us a call at 800-393-4001. Let us talk to you about how we do it at the Armstrong Advisory Group. Offices all throughout New England. You can book an appointment or schedule a call by calling 800-393-4001 or schedule a call back at armstrongadvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services.
All right, we got one out of left field here, Paul. I didn't think we were going to be talking about this issue today, but auto industry panicking about another chip shortage. I thought that we were done with chip shortages for the auto sector at least, but back at the forefront potentially here. I was much more nervous about tariffs and bankruptcies of parts suppliers, but now we are back into the story of chip shortages for major auto companies. Why are we talking about this today?
The enjoying part of our job, Mike, is it's something new every day. Earlier this week, Chuck and I were talking about cooking oil and soybean issues between China and the U.S., and here we are back on the chip issues. But what we're dealing with specifically here is Nexperia, which is a Dutch chip maker with about 40% market share in basic automotive chips. Their shipments have been halted because the Dutch government took it over from its Chinese owner. So basically there was this company out there called Wintech Technology, a Chinese company, which is on the U.S. trade blacklist. The Dutch government came in and seized Nexperia, which is kind of underneath that Wintech Technology, and took it back over, stating that it has to keep Europe from losing its technological capabilities and its knowledge there. It deals with some of the issues that have gone on with concerns about exporting. It bleeds into some of the rare earth stuff that we've talked about too, where China had stepped in and said, all right, you know what, we're going to seize some of these exports as a result of this takeover that they did.
Raise your hand if you've ever heard of Nexperia before today. Right? Like, this is how sensitive these supply chains still are. There's some Dutch company that no one here has ever heard of that accounts for 40% market share in basic auto chips. Who knew? Who knew? Let's take a quick break. When we come back, I think that's enough for the auto industry for the moment. Let's talk a little bit about oil because prices have been on the move. A little bit of good news for those of us at the pump, but what does it mean for the overall economy? That's next on the Financial Exchange.
Find daily interviews and full shows of the Financial Exchange on our YouTube page. Like us on YouTube and get caught up on anything and everything you might have missed. This is the Financial Exchange Radio Network.
Mark Vonner is the CEO of Veterans Development Corporation. His dedication to serving our veterans has made an incredible impact on his family and employees. And he is so proud to be the presenting sponsor of the DAV 5K Boston.
My name is Ashley Vonner, Director of Operations at Veterans Development Corporation. I wanted to learn the family business under the guidance of my father, Mark Vonner. VDC is more than a general contractor. It's a service-disabled, veteran-owned small business that goes above and beyond for the veteran community. With Mark's military background, serving in the Marine Corps, our company is committed to supporting the Disabled American Veterans Department of Massachusetts. VDC has been the presenting sponsor for the DAV 5K for many years, striving to spread awareness of this great organization. Working for Veterans Development Corporation has shaped me into the person I am today, and I am proud to be a part of this organization.
Please visit dav5k.boston to show your support today.
The U.S. Virgin Islands aren't just stunning, they're thriving and continue to be one of the hottest spots for vacationers in the Caribbean. New cruise port upgrades, better air connections, and a sharper focus on cultural experiences are putting the islands back on the map for travelers seeking something special. St. Thomas is your cruise hub, known for duty-free shopping and the world-famous Megan's Bay. St. John is pure escape with national park hikes, secluded beaches, and tropical tranquility. St. Croix brings the history with colonial architecture, old sugar mills, and vibrant coral reefs. Visit one island or all three and get plenty of pampering, undisturbed nature, and a vibe like no other, all jammed into one vacation. With easy travel from New England, no passport required, and no money to exchange, paradise is closer than you think. This fall, plan your getaway and fall naturally in rhythm with the heartbeat of the islands in America's Caribbean. Visit usvi.com and book your trip today. That's visitusvi.com.
Hi, this is Mike Armstrong from the Armstrong Advisory Group. Turning 70 isn't just another birthday. It's when the clock starts ticking on your retirement withdrawals. At age 73 or at age 75 if you were born in 1960 or later, you need to start withdrawing money from your IRA. They're called required minimum distributions, and missing one can mean big penalties. Taking the RMDs at the wrong time can also spike your tax bill. Even the type of account matters, since your IRA and 401k follow different rules, which could get confusing fast. Our new guide is called Understanding Required Minimum Distributions. It breaks the process down in simple terms so you know when to start, how much to take, and ways to manage the tax impact. Request your copy today by calling 800-393-4001. That's 800-393-4001 or ArmstrongAdvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services.
Here at the Massachusetts Department of Elementary and Secondary Education, we are committed to all students not only attending, but succeeding at school. Your presence is powerful. Share why you attend at doe.mass.edu.
Sponsored by the Massachusetts Department of Elementary and Secondary Education.
Let's talk LDL. AKA bad cholesterol. The higher your LDL cholesterol, the higher your risk of a heart attack or stroke. Your health matters. Know your number. Talk to your doctor and get your cholesterol checked. And learn how to help lower your LDL bad cholesterol. Because your health is in your hands. Find out more at heart.org/LDL.
Miss any of the show? Catch up at your convenience by visiting financialexchangeshow.com and clicking the on-demand icon where you'll find all of our interviews and full shows. This is your home for the latest business and financial news in New England and around the country. This is the Financial Exchange Radio Network.
Paul, it's still pretty cheap to fill up my cars. It's a national average of $3.05 a gallon. Looking across New England here, Maine's at $3.03, New Hampshire's at $2.96, Mass at $3.02, Connecticut at $3.07, Rhode Island at $2.96, and Vermont sitting at $3.14 per gallon. Did I give? Yeah, I gave Connecticut. So loving the cheap gas prices. I'm excited to, pay a little bit less for home heating oil this winter. But I don't know. I'm a little bit perked up about oil prices dropping below $60 a barrel. I mean, we're sitting right now, just an FYI, at $57.39 on West Texas crude oil. Most analysts out there and most who look closely at the oil industry look at that $60 range as kind of the break-even point for drilling new wells and getting oil to the ground in the United States. And so you do wonder, okay, how much new exploration and drilling is going to happen with oil sitting at these prices. But moreover, what does it say about the global economy to see oil prices sitting in the $60 range? To me, it doesn't spell fantastic news about, if you have oil demand so low that it's only able to garner $57 a barrel. I don't know. I'm not enthusiastic about what this might mean.
Yeah, and it seems like this could potentially, there isn't really a near-term fix for this. I mean, U.S. oil producers, they notched a fresh output record of more than 13.5 million barrels a day in July. You've got the Saudi-led OPEC announcing that they're going to boost production by 137,000 barrels a day in November. So it seems like
you got the massive oil field in Guyana now that's pumping. So, I mean, don't get me wrong. It's not only a demand equation here. We do have more supply that's able to be pumped. But, yeah, to see oil prices down here, I don't know. It to me spells that industrial demand and all that stuff is not terribly great at the moment.
Probably the case, but it's with energy projections, it's just the price can swing so quickly. It's hard to read too much into it. But I would agree with you. It does seem like industrial activity is down a bit, and maybe that's leading to some of these lower prices here.
New York Times reporting that Delta and United are leaving other airlines behind. So let's talk about how and why and will it stick. I mean, the airline industry has obviously become hyper-concentrated at this point in spite of a few judges shooting down merger attempts. What was it, JetBlue and Spirit that tried to merge? And now Spirit's, of course, in bankruptcy, and who knows what will happen with JetBlue. But these two are clearly standing out. I would toss American as kind of a third contender in here as well because they basically mirror each other's business models. But what's been working recently for these airlines compared to others?
Really what it is this shift to focus on making the most profit per seat on the first class and lounge premium seat experience. And I hate to keep bringing this up. We hit it on often. I do wonder if it's just focusing on the divergence in the consumer that we've kind of tracked, where the higher income consumers are accounting for a heavy percentage of spending nationally. And it seems like Delta and some of these in American have been these airlines that have, and United too, that have sort of shown this trend the most, where whether it's corporate business travel or first class seats, that is where they're making tremendous margins, Mike, and it's leading to profitability numbers that are really impressive for the airline sector, which is a very tough business to execute in. And it just seems like there's the haves and have-nots, both of airlines and just where the consumers are willing to spend money. Like, I just don't think you're seeing as much demand for those discount airlines and those travelers than you are from the first class travelers in Delta and United.
Look, airline travel is it's probably my definition of discretionary item.
Yeah.
Right? Like, even for businesses, You do not have to send your employees to go on an airline. You can tell them to do a Zoom meeting these days. It is the definition of discretionary spending is flights on airlines. And so I do find what is happening there to be intriguing. And it continues, like you said, this divergence we have been seeing of luxury right now is selling. Delta, in their most recent earnings call, reported that premium revenue increased by 9% year over year. So that is first class, it's business class, it's just premium spending in general. Main cabin ticket revenue was down 4% year over year for Delta.
Right.
That is a stark contrast. It spells right into what we've been talking about of the top 10% really keeping on the spending and the others not doing so. And in some ways, it makes me think, hey, will we see that dramatically pull back if you see an asset price pull back, and will the Spirits and the JetBlues and the Southwests have their heyday at that point? But I'm honestly not sure at this stage, because Delta and American and all these airlines have gotten so good at segmenting their business and still offering really cheap flights in their main cabins. I don't know if Delta does it, but American, I'm sure, has a completely stripped down ticket where you don't get to choose your seat, don't get to bring on a checked bag and everything. And so they can compete on price with Spirit in ways that they just chose not to in the past. And so even in the case of, let's say, markets fall apart and we have that period of time where luxury spending pulls back, I'm just not sure that the business is going to go to those discounters like it used to.
Yeah, it's just such a difficult business to execute. And I do worry about, like you said, it is such discretionary spending that it could fade very quickly from these larger aircraft carriers, that they don't continue to demand these type of profits on those seats. But I don't know how would you make a counter argument that the mid-size airlines can really compete? I just don't know what case I would make.
Yeah, it's tough too. By the way, this is not just something that's isolated to the airline industry. Marriott also reported earnings recently. What they found was their luxury segment saw growth of 4.1% in the U.S. and Canada, whereas their select service and extended stay, so their more discounted segment, 1.5% decline. So you're really seeing this across the board. And here's where I'll drive it all home. Consumer spending generally used to be driven by wages. It was driven by the wage that you have in your current job, as well as new people getting jobs and getting into the labor force, and that was what drove consumer spending. There's this insinuation by this data that now consumer spending is being driven by a wealthier, older population who I would presume is more being driven by asset prices and the wealth effect than they are by wages, because I don't know a ton of 70-year-olds who are working. It's mainly, hey, I've got Social Security and look how big my portfolio has gotten, and I went on Zillow and look what my house is worth. And that just reshapes things pretty dramatically. It just changes incentives. It changes a whole lot of the structure of the U.S. economy. If consumerism is now still there but driven by asset prices instead of income, I kind of have to rethink a lot of things in my head about how this whole structure works. We got to take a quick break, but have a ton more to cover in the second hour of the Financial Exchange. Stay tuned. We'll be right back, folks.
Are you over the age of 50? Want peace of mind and financial security for your family? Here's an important message to you from Senior Care USA. The average funeral now costs over $10,000. That leaves your loved ones the burden of paying your debts and funeral costs. Our plans start as low as $1 per day and will pay your family up to $30,000 to help pay for your funeral and other expenses. There are no medical exams. Your rates will never increase, and your plan cannot be canceled, regardless of your medical condition conditions as long as you make your premium payments. Get up to $30,000 in final expense insurance. Call now for free information. Just answer a few simple questions and get approved right over the phone in just a few minutes. Call right now.
Call 800-378-3818. 800-378-3818. 800-378-3818. That's 800-378-3818.
Did you outgrow your timeshare and now you want out? But you can't. You can't sell it, and you can't get out of the contract. Imagine trying to get out of your mortgage. That's what a timeshare is. You can't just call up the bank and say, I don't want to pay it anymore. But we may be able to help you do just that. Listen, a timeshare maybe for you once was a great thing, but now you don't use it much. And they are not easy to get rid of. Plus, you do have to pay for it every month. Qualified timeshare owners can get out of their contract legally and permanently without ruining your credit or even filing bankruptcy. And imagine, no more mortgage payment or fees. Call the Timeshare Exit Hotline qualification line now. It's free to learn more.
800-455-7967. 800-455-7967. 800-455-7967. That's 800-455-7967. Paid for by Timeshare Defense. Hey, listen, are you a 50-year-old person looking for term life insurance? Then you need to talk to Bob. Bob specializes in helping people find $1 million or more of term life insurance for a couple of $100 a month. Look, you need to know there's a price war in the term life insurance business, and you may be paying too much. Call Bob, and he'll shop and see how much money he can save you. Look, this could be the last term life insurance policy you ever have. Your rates are guaranteed for the next 20 years. That's right, guaranteed level rates for the next 20 years. And if you're a smoker or your health is not perfect, Bob has great rates for you too. So for $1 million of term life insurance coverage for a couple of $100 a month, call Bob right now. 800-965-7987. 800-965-7987. 800-965-7987. That's 800-965-7987. Paid for by Term Direct.
This is the Money Matters Radio Network, WBNW 1120 AM and W275 CM FM. Concord, Boston, the Money Matters Radio Network.
October 24th is National Food Day, a perfect time to celebrate fresh, local food right here in Massachusetts. Fall harvest season is in full swing with crisp apples, sweet pears, pumpkins, squash, cranberries, and hearty root vegetables at your neighborhood farmers market. Markets are still open, so grab your bag. Support local farmers and bring home the flavors of autumn. Sponsored by Mass Farmers Markets, helping grow farmers markets across the state. Find your local market at massfarmersmarkets.org.
The U.S. Virgin Islands aren't just stunning, they're thriving and continue to be one of the hottest spots for vacationers in the Caribbean. New cruise port upgrades, better air connections, and a sharper focus on cultural experiences are putting the islands back on the map for travelers seeking something special. St. Thomas is your cruise hub, known for duty-free shopping in the world-famous Megan's Bay. St. John is pure escape with national park hikes, secluded beaches, and tropical tranquility. St. Croix brings the history with colonial architecture, old sugar mills, and vibrant coral reefs. Visit one island or all three and get plenty of pampering, undisturbed nature, and a vibe like no other, all jammed into one vacation. With easy travel from New England, no passport required, and no money to exchange, paradise is closer than you think. This fall, plan your getaway and fall naturally in rhythm with the heartbeat of the islands in America's Caribbean. Visit usvi.com and book your trip today. That's visitusvi.com.
Mark Vonner is the CEO of Veterans Development Corporation. Mark is a career military man, having served for nearly 20 years, and we are so thrilled to have him and his company as a key partner and the presenting sponsor of the DAV 5K Boston. Mark comes from a proud military family, including his father Victor and his brother Timmy. Mark talks often about how serving his country was one of the greatest achievements of his life, and that's one of the key reasons that he chooses to give back to this special community. Mark is honored to continue his legacy that his father started when he built Veterans Development Corporation. Working to help many disabled veterans and their families has become a lifelong goal for Mark, and it's why he's taken the time to fully support the DAV Department of Massachusetts. You can join Mark Vonner and Veterans Development Corporation and help our great American heroes today by making a donation or becoming a sponsor. Simply visit dav5k.boston. That's dav5k.boston.
This is Michael Valila, Adjutant of the Disabled American Veterans Department of Massachusetts. The DAV of Massachusetts has helped me and countless others adjust to civilian life through a variety of incredible programs. Through our local Veterans Assistance Program, we provide necessary services to veterans and their communities, such as food shopping, landscaping, and companionship, but we need your support. You can help by making a donation today. Please visit dav5k.boston. That's dav5k.boston.
Hi, this is Chuck and Mike from the Armstrong Advisory Group, and our guide this month is titled Understanding Required Minimum Distributions. Mike, one area with some big changes the last couple of years has been RMDs as it relates to inherited IRAs. What is the lay of the land today?
Yeah, so critical things that you need to know is that for most inheritors that are not spouses, so that's your starting point. If you are not married to the person who passed away, you are most likely subject to a out in 10 rule. What has also changed is that you're required to satisfy two different rules for most folks. Again, you are required to empty that inherited IRA within a decade. You also have annual required minimum distributions based on life expectancy. So it is really complicated now for inheritors.
How does that potentially influence how a parent may leave assets to surviving children in terms of taking their incomes into account?
Yeah, well, I mean, look, it is going to concentrate this additional income in a decade time period after you're gone. And so it adds a little bit of complexity in terms of that estate planning, right? Maybe I've got two kids. One's a very high income earner. One is a little bit lower. Do I potentially reshape my beneficiaries so that they both receive the same amount, maybe after taxes? A lot of complex planning you can do there.
The guide this month is titled Understanding Required Minimum Distributions. The two ways that you can request it are by calling 800-393-4001 or by visiting armstrongadvisory.com. Again, that number is 800-393-4001, or you can request it at armstrongadvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services. The Financial Exchange is produced by Money Matters Radio and is hosted by employees of the Armstrong Advisory Group, a registered investment advisor. All opinions expressed are solely those of the hosts, do not reflect the opinions of Armstrong Advisory or anyone else. Investments can lose money. This program does not offer any specific financial or investment advice. Please consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong Advisory and the advertisers heard on this program do not endorse each other or their services. Armstrong and Money Matters Radio do not compensate each other for referrals and are not affiliated. This is the Financial Exchange with Mike Armstrong and Paul Lane. Your exclusive look at business and financial news affecting your day, your city, your world. Stay informed and up to date about economic and market trends, plus breaking business news every day. The Financial Exchange is a proud partner of the Disabled American Veterans Department of Massachusetts. Help us support our great American heroes by visiting dav5k.boston and making a donation today. This is the Financial Exchange with Mike Armstrong and Paul Lane.
Good morning. Welcome back to the Financial Exchange. It's a Friday here. Wall Street is in mixed territory at the moment. We've got the NASDAQ off by about 20 points, whereas Dow and S&P are slightly in positive territory. It's been volatile so far, though. We had futures markets down by over 1% at one point. They've rebounded since. The president had some commentary on China earlier this morning that was a little bit more conciliatory than what we've seen over the last week or so, but continued turmoil when it comes to private credit markets, First Brands, bankruptcies in that space, and what it could mean for the large area. And then, look, there does seem to be, I think, a shift in the narrative a bit over the course of the last several weeks about concerns about the AI boom and, the comparisons to be made to the dot-com bubble.
How so?
I just think the narrative shifted a little bit. I think it's become more in the commonplace to question that a bit more. I think it's been more in the narrative of, hey, this is actually starting to get concerning from a valuation perspective, much more than I heard back in June, July, and August.
Yeah, I would agree with that. I think the announcements of all the deals that OpenAI has struck with a bunch of the big hyperscaler players in the space, the Googles, the Microsofts, etc., Oracle, that has put more scrutiny on all this infrastructure build out. Is it going to be justified? Yeah, I would.
We're also entering day 17 of the government shutdown. We'll be getting inflation data in spite of that shutdown next Friday. They're deeming that data necessary because it will determine cost of living adjustments for Social Security. Open questions as to whether we get other data points, such as the jobs report that was missed for September, the jobs report for October that's supposed to be getting collected right now, the data is supposed to be getting collected right now. So continued questions about the government shutdown and overall impact, although to this point I would call the overall push from the general consumer and push back from government employees to be, I don't know, just not the top story that's being covered, and I don't think quite elevating to the point where lawmakers feel a need to act so far. That can turn pretty quickly. Next week, in addition to that CPI print, we'll be hearing on earnings from a few big companies, including Netflix and Tesla, among many others. And then big interview, actually, on the show on Tuesday of next week. Andrew Ross Sorkin will be joining us on Tuesday during the show to talk about his new book, 1929, which I'm still making my way through. But it's an excellent piece on the Great Depression and an entertaining piece, too, because it really takes it from the perspective of a lot of public figures that we know and think about today, Winston Churchill and Al Smith and many others who, common names even today, and a lot of the founders of big banks that exist today. So big interview coming up on Tuesday next week on that piece too, which I'm excited about. But Paul, for 3 years now, this bull market has continued and defied any concerns that it has about tariffs and semiconductor restrictions and bank failures and inflation. Where, I guess, has that been surprising to some extent? And the New York Times has a piece this morning that I'm not sure really what the point of it is to say, other than markets have gone up over the last 3 years in spite of concerns, to which I say, welcome to the stock market.
Right.
But is there any other conclusion that we can draw here based on this piece? Because to me, it was mainly a backward-looking informational piece, which if you need information on what the markets have done in the last 3 years, then go ahead and read it. I'm not trying to completely chastise it, but I didn't take anything out of it of importance.
Yeah, it's the message from it could have been summarized in probably 3 words, and it often is what is used when we do TV spots. They clip out this one thing that I say, stay the course. Hey, Paul, what should everyone do? Stay the course. Like, this is kind of the takeaway from this piece is, 3 years ago, you probably would have thought that we were on the precipice of recession and potentially we could anticipate weaker stock market returns, but the market has defied expectations. But like you said, it's always kind of done that.
Defying expectations.
It's always not what you anticipate, and there's always going to be concerns, but ultimately it reinforces kind of what Mark Vendetti says so much all the time. That's ingrained in my head. Staying the course, believing in your allocation, and focusing on the long term. I will say, looking back, it is incredible, the returns, if you look at the trough of October of 22 to where we are today. But that's picking a perfect point in time where markets were really low and now they're really high.
I always try and glean something useful from this, and it's not mentioned here, but I think what I will repeat over and over again is that valuations are in the upper echelons of what we have ever seen. And by valuations, I mean stock price to earnings ratios, cyclically adjusted price to earnings ratios, price to revenue, price to book, price to sale, any metric that you want to look at. Almost all of them are in the 95th plus percentile of what we've ever seen. Unfortunately, that doesn't tell you anything about what's going to happen in the immediate future. Doesn't even tell you what's going to happen in the long term. But what you can do is take a look at other moments throughout history where you've gotten to even similar areas, and pretty much universally, what it has led to over the course of the next decade has been below average returns for stocks. And that's as much as I am willing to say about where we are in this moment. Is doesn't mean we're going to have a crash, doesn't mean that we're going to have a continued boom. What history has told us, though, is every time that markets have gotten nearly as pricey or pricier than where we are now, is that it has meant below average returns for the future. Sometimes negative, sometimes just less positive than they usually are, but that has been the lesson that I think is the one lesson you can actually take and apply to today. Is historically, that is what has happened when we've gotten to where we are now.
Yeah, that's a very fair point. If you look at the trailing 5-year average on the S&P 500, you're sitting around 15% right now. What
Sure.
do we know about the long-term historical average? It's nowhere near that high. So I think the argument is, how do you get back to the normal average is probably some periods of lesser returns to bring you back to that kind of 9% average that the S&P will typically do over an extended period of time.
Let's take a quick break. When we come back, a little bit of trivia here next on the Financial Exchange.
Hear the Financial Exchange every day from 11 to noon on SiriusXM's Business Radio Channel 132. Keep it here for the latest business and financial news and the trends on Wall Street. The Financial Exchange is now live on SiriusXM's Business Radio Channel 132. This is the Financial Exchange Radio Network. The U.S. Virgin Islands aren't just stunning, they're thriving and continue to be one of the hottest spots for vacationers in the Caribbean. New cruise port upgrades, better air connections, and a sharper focus on cultural experiences are putting the islands back on the map for travelers seeking something special. St. Thomas is your cruise hub, known for duty-free shopping and the world-famous Megan's Bay. St. John is pure escape with national park hikes, secluded beaches, and tropical tranquility. St. Croix brings the history with colonial architecture, old sugar mills, and vibrant coral reefs. Visit one island or all three and get plenty of pampering, undisturbed nature, and a vibe like no other, all jammed into one vacation. With easy travel from New England, no passport required, and no money to exchange, paradise is closer than you think. This fall, plan your getaway and fall naturally in rhythm with the heartbeat of the islands in America's Caribbean. Visit usvi.com and book your trip today. That's visitusvi.com. Cushing & Dolan want to help you avoid costly mistakes when it comes to gifting assets to your children. Their brand new guide, Making the Most of Gifting Assets, shares crucial strategies to help you protect your legacy and your family. Many people think gifting is always a good thing, but if it's done the wrong way, it can create real headaches. Even well-intentioned gifts can cause complications if your children are dealing with financial pressure or legal issues like a divorce. The guide also explains how a major gift, like a home or vacation property, could come with hidden tax consequences that may impact your entire estate plan. Before you make any big moves, arm yourself with the facts in this new guide from Cushing & Dolan. Call 866-848-5699 right now to get your copy. That's 866-848-5699. Or request it online at LegalExchangeShow.com. That's LegalExchangeShow.com. The proceeding was paid for and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing & Dolan and Armstrong Advisory do not endorse each other and are not affiliated.
Hi, this is Chuck Zodda from the Armstrong Advisory Group. Required minimum distributions, or RMDs, may seem simple, but there's a lot more to them than just taking money out of your IRA. RMDs impact how much you pay in taxes, and they can push your income into higher brackets. And if you miss one, the penalties can be steep. They also affect how much your heirs actually get to keep, which makes timing and strategy crucial. If you have multiple accounts, it's important to know which ones you can combine and which ones you can't in order to help you avoid costly mistakes. Our new guide, Understanding RMDs, shows you how to navigate the rules, limit your tax burden, and plan ahead for your legacy. Request your copy today by calling 800-393-4001. That's 800-393-4001, or you can request the guide from our website, armstrongadvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services.
Environmental nonprofit Ocean River Institute is working with communities to tackle climate change with nature-based solutions that feature slowing water down and building more soil with grasses and plants. Research indicates that people acting in their own neighborhoods can build an inch of soil in a year and slow sea level rise down by as much as 25%. Please visit oceanriver.org for more information on opportunities to make a difference and go the distance for savvy stewardship of a greener and bluer planet Earth.
As a busy mom to 4 kids, my to-do list is full.
Trying to fit in exercise, eating right, and prioritizing self-care can feel next to impossible.
While we can't add more hours to the day, we do have a great resource to help.
Go Red for Women has easy tips, tools, and information to help you and your family live a healthier life.
So to all the moms, the aunts, grandmothers, and amazing women out there doing it all,
visit goredforwomen.org/momlife today.
You take care of them, Go Red for Women will take care of you.
The Financial Exchange streams live on YouTube. Subscribe to our page and stay up to date on breaking business news all morning long. This is the Financial Exchange Radio Network.
The Financial Exchange is a proud partner of the Disabled American Veterans Department of Massachusetts, and this year's DAV 5K is Saturday, November 8th at Castle Island. The race is now sold out, but you can still take part by making a donation to support our great American heroes. Please visit dav5k.boston to make your gift today. Your participation helps provide vital services like free transportation to medical appointments and safe housing for single veterans and their families. Donate today at dav5k.boston. That's dav5k.boston. Time for trivia here in the Financial Exchange. And next week, Orkin, the pest control company, will release its annual Rattiest City in America list. One city has dominated the list, coming in first for 10 years running. So our trivia question today, according to Orkin, what has been the rattiest city in America for the last decade? And once again, according to Orkin, what has been the rattiest city in America for the last decade? Be the sixth person today to text us at 617-362-1385 with the correct answer, and you win a Financial Exchange Show t-shirt. Once again, the sixth correct response to text us to the number 617-362-1385 will win that t-shirt. See complete contest rules at financialexchangeshow.com.
We've been talking a lot about the Jefferies and First Brands story. Jefferies being the investment bank that had lent a fair bit of money or originated some loans to First Brands. Bit of breaking news on that story. Jefferies chief executive Rich Handler has told investors that the bank believes it was, quote, defrauded after being grilled over its exposure to bankrupt auto parts supplier First Brands Group. The stock of Jefferies has fallen a good 25% over the course of the last month, almost all concentrated on this one deal, which they apparently have a fair bit of exposure to. So we'll keep you posted on new updates on this, but Tucker brought it to us and thought it was worth mentioning that the term fraud, which we've been talking about and many media outlets have been talking about, is now being echoed by the CEO of the big investment bank, Jefferies. So we are now through big bank earnings, Paul. I think the only conclusion you can really come to with the big banks has been that they seem fine.
Yes.
No real exposure to any of this stuff in any meaningful way. JP Morgan did disclose some exposure to Tricolor, but the commentary from them has been, what did Diamond say, where there's one cockroach?
There's often a few more.
Yeah, something along those lines, insinuating that, hey, we had this exposure here. It doesn't matter to our bank, but we would be surprised if there weren't more types of this exposure and problems elsewhere, because when you see one, you generally see a few. Any other, I guess, big picture concerns or optimism that you can glean from the big banks?
I think you had used the word fine before to describe the big banks earnings, but really they were
more than fine.
Tremendous is probably, they were very good. These earnings were quite strong. I think what it signals is a really increased appetite for deal-making activity. You saw investment banking fees on a lot of these big banks rise significantly. So what does that mean from a optimism standpoint on the economy, businesses are looking to merge and acquire other businesses out there, and that's why you're seeing an uptick in some of the revenue there. And then trading activity has been really robust for these big financial banks. They've made a lot of money off of trading on the fixed income side and the equity side of things as markets have been really active this year. We've talked about some of the areas of speculation in the market. You've had a market that's done well, and there's been a lot of enthusiasm behind it. So all those factors combined have led to big banks doing pretty well. And it's fair to say that some of these regional banks actually have come in with pretty reasonable earnings as well, aside from some of the ones that mentioned their concern or mentioned losses from some of these auto manufacturer or these auto industry companies' bankruptcies. There's been some good regional bank earnings too.
There have. One other company that did report just this morning was American Express. We mentioned this one as important, not just because it is a big company. They're a $236 billion company now, but speaks to the same wealth effect spending trends that we have seen here. American Express obviously serving a higher end clientele, generally higher net worth, higher income, expensive credit cards. Didn't they just roll out like a $900 a year annual fee credit card, or was it $800? There's a big bump.
JP Morgan or Chase has come out with a big one that has an annual fee in that ballpark. I think they're the premium focus, just like what we talked about. These card issuers are coming out with some really high annual fee products for that higher income
In
consumer.
any case, American Express stock up about 5% in early trading today after this morning's earnings guidance. They had a solid quarter. Revenue increased 11% year over year, a record $18.4 billion, which exceeded forecasts. The other big piece here, they increased their full year 2025 guidance. On top of that, net income grew 16% to $2.9 billion. Earnings per share rose 19%. Again, for any company that really services a high net worth clientele and relies on the spending of that clientele, it is a good news scenario right now.
It is $895, that annual fee for the American Express Platinum card. And what Chase did is they have a Chase Sapphire Reserve that went from $550 to $795 for their annual fee for those cards.
It seems like they're just chasing Amex.
Yeah, they are. I forget who announced it first. I thought it was Chase, but
it was supposed to be a stupid play on words, Chase. Nobody got it. It wasn't funny in the first place. Thanks a lot, guys. You didn't even play the car crash joke. Thank you, Tucker. So that leads us to the question about interest rates, because rates came down a full percentage point last year. They've now come down. Am I losing it? Have we had 0.5% of rate cuts, 0.25% of rate cuts so far this year?
Just
September,
just a quarter. But another one's coming in 12 days.
In 12 days, we will likely get another one. We'll talk about that. But credit card APRs not really coming down, and I think it's important for us to continue to revisit stories like this that actually apply to the average consumer about why, when the Fed is cutting interest rates, are we not seeing mortgage rates come down, or auto loan rates, or in this case, APRs on credit cards coming down. The APRs on credit cards is a little bit more surprising than mortgage rates. I think we've pointed this statistic out before, but historically speaking, when the Fed is cutting interest rates, and they are not doing so in a recession, which, again, you don't know whether or not you're in a recession until after, but we can look back and look at this statistic. Mortgage rates only come down about half the time. It's a coin flip as to whether or not mortgage rates come down when the Fed is cutting outside of a recession. And so that one's not entirely unexpected. But APRs, these are short-term rates. You do generally anticipate that, hey, Fed cuts rates, HELOCs come down, savings accounts come down, and yes, credit card APRs start to come down. Not what has been happening so far since Fed embarked on this rate cutting cycle.
Yeah, Jennifer Doss, who's from creditratings.com, the executive editor, has stated that the correlation between that Fed funds rate, the cuts, and credit card rates is weaker than expected. The reason behind it, she says, it's heavily influenced by credit conditions and individual credit scores, which I don't really, that's very broad and vague.
Here's my summary. These credit card companies, maybe other than Amex, are terrified of their customers. They're terrified of defaults. They are seeing balances way up. And so how do you mitigate against the eventual default of your credit card customer? You charge the hell out of interest while you can.
Fear and also greed, right, to continue those margins on your credit card business that you just hope you can kind of drag your feet longer before you lower in commensurate with the Fed Reserve cuts.
Yeah, you think about it for a moment here. Like, I don't know a lot of people that are going to be changing their credit card or applying for one card over another based on a 19.5 versus a 20% interest rate. Do you?
No.
Like, that's not where these companies compete.
It's the rewards.
It's the rewards. It's because everyone who signs up for a credit card saying, I'm planning on not paying this back, so what's the lowest interest rate I can get? It's not a mortgage, right? You don't go shop from that perspective. Everyone who's ever gotten a credit card says, I'm responsible. I'm going to pay this money back every month. I'm going to get my rewards. I'm going to be the perfect goody two-shoes. Of course, 60% of credit card holders don't do that. But I don't think the rate's the big draw for most people.
No, outside of those balance transfer cards, but that's a whole nother deal where you take your balance and move it over to a zero interest for an 18 to 24-month period. Then they start hitting you with interest. But yeah, outside of that, it's all about rewards and other factors, not the interest rates.
In any case, we'll be heading, as Paul mentioned, into a Fed meeting just before Halloween. Jay Powell very likely now has a full backing to cut rates. I think there may even be some compelling evidence depending on what happens with these with these loans to different companies. If we see any further cracks in the foundation, I think you could even see a push for a 50% rate cut. But right now, the markets are settling in on a 25 basis point rate cut in October when the Fed next meets. There's a 99% chance of that outcome, only a 1% chance of a further cut. So we'll be keeping an eye on that, but clearly I think we've got a couple more rate cuts through 2025. And then, yeah, things get a little bit less certain once we get to 2026. And, Jay's in senioritis mode at that point because he's on his last few days in the job. Quick break, Wall Street Watch coming up next.
Bringing the latest financial news straight to your radio every day. It's the Financial Exchange on the Financial Exchange Radio Network.
Hi, this is Mike Armstrong from the Armstrong Advisory Group. If you're approaching your 70s, you might be thinking about slowing it down, but the IRS is just getting started. Required minimum distributions, or RMDs, kick in starting at age 73. And if you were born in 1960 or later, that number jumps to 75. RMDs are more than just a box to check. They can impact your taxes, your income plan, and even what you leave to your heirs. If not done properly, it could mean big penalties, but getting them right might help keep your money working for you. Our latest guide, Understanding RMDs, breaks down how they work, when to take them, and strategies that may make them less of a tax headache and more of a financial opportunity. Request your copy today by calling 800-393-4001 or by visiting ArmstrongAdvisory.com. That number again is 800-393-4001 or ArmstrongAdvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services. The U.S. Virgin Islands aren't just stunning, they're thriving and continue to be one of the hottest spots for vacationers in the Caribbean. New cruise port upgrades, better air connections, and a sharper focus on cultural experiences are putting the islands back on the map for travelers seeking something special. St. Thomas is your cruise hub, known for duty-free shopping and the world-famous Megan's Bay. St. John is pure escape with national park hikes, secluded beaches, and tropical tranquility. St. Croix brings the history with colonial architecture, old sugar mills, and vibrant coral reefs. Visit one island or all three and get plenty of pampering, undisturbed nature, and a vibe like no other, all jammed into one vacation. With easy travel from New England, no passport required, and no money to exchange, paradise is closer than you think. This fall, plan your getaway and fall naturally in rhythm with the heartbeat of the islands in America's Caribbean. Visit usvi.com and book your trip today. That's visitusvi.com.
Mark Vonner is the CEO of Veterans Development Corporation. Mark is a career military man, having served nearly 20 years, and we are so proud to have him and his business as a key partner and a presenting sponsor of the DAV 5K Boston. The DAV Department of Massachusetts does incredible work, and it's one of the first organizations that Mark became familiar with after his military service ended back in 1984. As Mark built his company, he knew he'd be giving back to fellow veterans who needed jobs, support services, medical supplies, and so much more. Mark works with disabled veterans every day, and it's one of the key reasons why he's such a big supporter of Dan Stack, the DAV Department of Massachusetts, and the DAV 5K Boston. You can join Mark Vonner and his team and make a donation to the DAV Department of Massachusetts or become a sponsor of the DAV 5K Boston. Simply visit dav5k.boston. That's dav5k.boston.
This is Tucker Silva of the Financial Exchange Show, and I'm joined today by estate planning attorney Todd Lutzke, a partner with the law firm of Cushing & Dolan with a master's in taxation. And today we're talking about the implications of gifting assets away. Todd, since the estate tax laws are projected to change on January 1st of 2026, significantly reducing the estate tax exemption, does it make sense to gift away assets right now?
You know, it's a big question mark. You have to think of a few things. One, look at the size of your estate. If the exemption falls to $7 million each and you're married, you can still die with $14 million of assets and not have an estate tax. So gifting might not be important from a federal gift tax situation. But the state exemption is only $2 million, so you can only shelter $4 million. So you might want to gift to reduce your state estate tax. However, there's basis to consider. If you give away low basis assets, you're trapping capital gain. And to do that, you might be paying more in capital gains taxes later when the kids sell the assets than you're saving in just Massachusetts estate tax. So you really got to think about whether it makes sense to gift or not. And if you're going to gift, you should probably set up a gifting trust. People might be gifting large assets away and not gift the assets directly to a child. Have them in a trust for the child's benefit and then protect those assets for them.
Educate yourself about the implications of gifting your assets away. Request your free copy of Todd's brand new guide called Making the Most of Gifting Assets right now by calling 866-848-5699. That's 866-848-5699. Or you can request a copy from their website, legalexchangeshow.com.
The proceeding was paid for and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing and Armstrong do not endorse each other and are not affiliated. Time now for Wall Street Watch. A complete look at what's moving markets so far today, right here on the Financial Exchange Radio Network.
Seeing some volatility on markets today as investors weigh regional bank concerns. This comes after Zions Bancorp said it would take a large loss, accusing some borrowers of fraud. Right now, the Dow is edging higher, up only 24 points. S&P 500 is down about 0.25% or 18 points. NASDAQ down by 0.6% now, or 134 points lower. Russell 2000 selling off over 1% now. 10-year Treasury yield is up 2 basis points at 3.999%, and crude oil is mostly flat, dipping into negative territory at $57.39 a barrel. After yesterday's 10% plunge, shares in Jefferies bouncing back about 5% today. Oppenheimer upgraded the stock to outperform, where the firm said Jefferies' exposure to First Brands is very limited. Furthermore, the Financial Times recently reported that Jefferies' chief executive has told investors that the bank believes it was defrauded after being questioned over its exposure to bankrupt auto parts supplier First Brands. Meanwhile, another big financial name, American Express, beat third quarter expectations and raised its full-year guidance. Amex up by 5%. Elsewhere, shares in Ozempic maker Novo Nordisk falling 4% after President Trump said the cost of the weight loss drug could be $150 or much lower than it is now. Oracle pulling back by 7% today following its rally yesterday after Oracle confirmed a cloud computing deal with Meta. And Apple and Formula One announced a 5-year U.S. media rights deal that will bring all races to the Apple TV platform beginning next season. CNBC is reporting that Apple is paying about $140 million per year for F1 rights. Apple shares are up by about 0.5%. I'm Tucker Silva, and that is Wall Street Watch. And in the previous segment, we asked you the trivia question. According to Orkin, what has been the rattiest city in America for the last decade? That would be Chicago. Dorothy from Wareham, Mass. is our winner today, taking home a Financial Exchange Show t-shirt. Congrats to Dorothy. And we play trivia every day here in the Financial Exchange. See complete contest rules at financialexchangeshow.com.
Tucker, I'm pretty sure you just rounded to the 1,000th% in one of your
He was messing around, dropping extra nines.
Just lots of nines.
3.999. 999. 9 times.
I like that. That is the accuracy and attention to detail that people tune in for. So thank you, Tucker.
I'll never pass an opportunity to say
you
999.
You also have had some great music intros today, Tucker, so good job by you. There's one where I was ready to run through a brick wall.
Thanks, man.
Yeah. Unfortunately, that's not a great...
we have a glass studio here.
It's not a great level of energy to bring to a radio show, unfortunately.
I didn't do it. I said I wanted to.
Yeah, I got it. I got it. So small businesses, CNBC has a really, actually, I think, really good piece on small businesses and tariff-related costs. They definitely cherry-pick a bunch of companies that are heavily affected by tariffs, but they, I think, bring something home for me, which is small businesses are getting crushed on the tariff front for those that are exposed to it. And it may help explain part of what we're seeing in the labor market, too. We tend to focus on big employers because they're easier to cover. We get more data on them. They release earnings. They have to announce their layoffs in very public fashion. But the fact remains that of employees that work for private companies, so non-governmental employees, between 45 and 47% of them work for small to medium-sized businesses, those with fewer than 500 employees. And as we've known this whole time, those are the ones that are really struggling with tariffs. It's not Walmart.
Right.
Walmart's basically gone to their Chinese suppliers and said, we have to pay tariffs, so lower your prices or we're going to buy it elsewhere.
Yep.
And they've capitulated. By and large, they've capitulated. They've found ways to do this. And in the cases where they do need to pay big tariffs, guess what? They've got pretty deep pockets. If they need to, they'll issue debt. They probably don't even need to. They can come up with the tariff payments. However, when you are AV Universal Corp, a small footwear company that's barely existed for 9 years and sells through retailers like Macy's and Nordstrom, and your tariff fee goes from $7,500 to $250,000, you're left in a pretty tough spot. In this case, the owner of the business decided to take out a loan. He's 64 years old. He took out a line of credit coming at a 32% interest rate because
that was staggering.
I mean, again, you're a small business. This is what you're looking at.
Right.
If you need to take, some sort of secured or even unsecured loan, that's the rate that you're talking about. And this is not incredibly unique. One, if you're AV Universal, good luck manufacturing those shoes in the United States anytime in the near future. It's not practical. But they go through a good 6 or 7 companies here, very few employees, but you're seeing pretty universally tariff fees doubling compared to 2024 on their products coming into the United States. And so while we might not be seeing it in prices, we might not be seeing it in big publicly traded companies, which you and I care most about here on the Financial Exchange, I do think it helps explain what we're seeing in the labor market.
That you don't have just nearly as much hiring in some of those sectors. Yeah, it's an issue that really that I have a lot of concern over, though it won't come directly in the data that you and I dive into every single day of publicly traded companies. But what happens on these small to mid-sized companies, it is concerning because they do account for a significant percentage of GDP growth, and it is a lot of employers out there. And you just think about some of these increases that you're seeing in the sample of companies that they mentioned here are unsustainable.
The only reason they're paying this, instead of just throwing up their hands and saying send the stuff back to India, is because they're hoping that they can get through one big season and then basically
there's
next
a reprieve
year,
after.
Next year either there'll be a reprieve or they just won't order the stuff.
Right. It just that part is very concerning because you look at what these businesses do, and it's so important to have these businesses in our country, but how does this not get just swallowed up by the bigger retailers if you have these companies like UAV Technologies just fold up shop because they're going from a doubling in the cost of the tariffs that they pay, or in some other cases that are mentioned in this piece, I mean, you're talking exorbitant increases, more than double. How do you keep the lights on?
I'll be very surprised if 5 years from now, the general retail sector is less concentrated than it is now. Again, retail isn't the only thing that matters, but like when I think through that, I'd be very, very surprised if small businesses that exist today are able to continue to exist 5 years from now at the same scale and degree that they do. I do just think that what it's going to mean, for better or worse, whether you like it or dislike it, that big businesses are going to get bigger as a result of some of these tariffs because they can better navigate it. It's just, that's the fact of a big business, is they have the attorneys, they have the staff to be able to figure out where is the best place for us to manufacture this stuff to lessen our tariff impact and just deal with the tariffs in the places that it makes sense to do so.
Cushing and Dolan want to help you avoid costly mistakes when it comes to gifting assets to your children. Their brand new guide called Making the Most of Gifting Assets shares crucial strategies to help you protect your legacy and your family. Many people think gifting is always a good thing, but if it's done the wrong way, it can create real headaches. Even well-intentioned gifts can cause complications if your children are dealing with financial pressure or legal issues like a divorce. The guide also explains how a major gift like a home or vacation property could come with hidden tax consequences that may impact your entire estate plan. Before you make any big moves, arm yourself with the facts in this new guide from Cushing and Dolan by calling 866-848-5699 right now to get your copy called Making the Most of Gifting Assets. Once again, the number is 866-848-5699, or you can request it from their website, legalexchangeshow.com.
The proceeding was paid for, and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing and Armstrong do not endorse each other and are not affiliated.
Well, while Elon Musk has been facing all sorts of questions about Tesla's full self-driving and autonomous taxis down in Austin, Texas, Honda beating them to the punch with their full self-driving lawnmower, which we don't have pricing details on.
Yeah, we do. Bottom of the article.
No. That's the manual model. So Honda hasn't revealed the pricing for the autonomous unit yet, but the regular old lawnmower that isn't autonomous is going to go for $33,000.
Wait, what?
Yes.
That's not possible.
Espresso Mike is on his game. Good catch on that.
Yeah, I can read despite what some of you insinuate.
So the human-operated lawnmower,
$33,000.
So can I take it on the highway and drive it?
I just had a client who bought a used car
lot
for in
of
around
bugs in
this
your
level
face.
too. Yeah,
What makes
$33K.
this so good, where it has to be this higher price than the used car right now?
Ask Honda, Tucker. I'm not entirely sure. I don't think there's going to be a huge market for it. I think they're going to have to get that price down a little bit. I mean, before I saw the price, I was like, okay. I mean, not that I would buy it, but my brother's a landscaper. If he had one of these puppies and could send it on its way to mow my lawn while he takes care of the other jobs that need to be done around my house, that might be something that he could stomach at less than $33,000 per year.
I just don't know how I feel about a self-driving lawnmower.
Oh, I'm all on board. Yeah.
I'd have to watch from the window and make sure it's,
Yeah, I mean, you might not want to leave your kids out in the yard at the same time.
Or your dog or something.
But,
that'd be bad news.
Test
Can you imagine the lawsuits that would come with that?
Quick
Taking
break.
down Sparky.
When we come back, Paul LaMonica from Barron's joining
Grass
us.
looks good, though.
Doug died, but the grass looks okay.
Paul LaMonica, Barron's, next on the Financial Exchange.
The Financial Exchange Show podcast drops every day on Apple, Spotify, and iHeartRadio. Hit that subscribe button and leave us a 5-star review. You're listening to the Financial Exchange Radio Network.
Hi, this is Chuck Zodda from the Armstrong Advisory Group. Required minimum distributions, or RMDs, may seem simple, but there's a lot more to them than just taking money out of your IRA. RMDs impact how much you pay in taxes, and they can push your income into higher brackets. And if you miss one, the penalties can be steep. They also affect how much your heirs actually get to keep, which makes timing and strategy crucial. If you have multiple accounts, it's important to know which ones you can combine and which ones you can't in order to help you avoid costly mistakes. Our new guide, Understanding Understanding RMDs shows you how to navigate the rules, limit your tax burden, and plan ahead for your legacy. Request your copy today by calling 800-393-4001. That's 800-393-4001, or you can request the guide from our website, armstrongadvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services.
Mark Vonner is the CEO of Veterans Development Corporation. His dedication to serving our veterans has made an incredible impact on his family and employees. And he is so proud to be the presenting sponsor of the DAV 5K Boston.
This is Brittany Vonner. I'm a registered nurse who is now working as an assistant project manager at Veterans Development Corporation. Working with my father, Mark, has been an incredibly rewarding experience. Our company is dedicated to serving VA hospitals and veteran communities. We don't just build facilities, we build environments that support healing, resilience, and family. We are so proud to see our work directly impact the lives of veterans and the professionals who care for them. This rich history is why we care so much about supporting great organizations such as the Disabled American Veterans Department of Massachusetts in the work they do to care for our veterans.
Join Veterans Development Corporation in thanking our great American heroes. Please visit dav5k.boston to show your support today.
Cushing & Dolan want to help you avoid costly mistakes when it comes to gifting assets to your children. Their brand new guide, Making the Most of Gifting Assets, shares crucial strategies to help you protect your legacy and your family. Many people think gifting is always a good thing, but if it's done the wrong way, it can create real headaches. Even well-intentioned gifts can cause complications if your children are dealing with financial pressure or legal issues like a divorce. The guide also explains how a major gift, like a home or vacation property, could come with hidden tax consequences that may impact your entire estate plan. Before you make any big moves, arm yourself with the facts in this new guide from Cushing & Dolan. Call 866-848-5699 right now to get your copy. That's 866-848-5699. Or request it online at LegalExchangeShow.com. That's LegalExchangeShow.com. The proceeding was paid for and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing & Dolan and Armstrong Advisory do not endorse each other and are not affiliated.
Hey, listen, are you a 50-year-old person looking for term life insurance? Then you need to talk to Bob. Bob specializes in helping people find $1 million or more of term life insurance for a couple of $100 a month. Look, you need to know there's a price war in the term life insurance business, and you may be paying too much. Call Bob, and he'll shop and see how much money he can save you. Look, this could be the last term life insurance policy you ever have. Your rates are guaranteed for the next 20 years. That's right, guaranteed level rates for the next 20 years. And if you're a smoker or your health is not perfect, Bob has great rates for you too. So for $1 million of term life insurance coverage for a couple of $100 a month, call Bob right now. 800-965-7987. 800-965-7987. 800-965-7987. That's 800-965-7987. Paid for by Term Direct.
The Financial Exchange is live on SiriusXM's Business Radio Channel 132, weekdays from 11 to noon. Get the latest business and financial news from across the country and around the world, and keep up to date on how it might affect your wallet. That's the Financial Exchange, weekdays from 11 to noon on SiriusXM's Business Radio Channel 132. This is the Financial Exchange Radio Network.
Ladies and gentlemen, the weekend.
Joining us now is Paul LaMonica from Barron's, talking to us about a few different areas, but all surrounding PayPal and their relatively abysmal year they've had. Paul, thanks for joining us. Appreciate it.
Thanks a lot.
So let's start off with the funnier of the two stories, if I may, because I doubt PayPal shareholders are laughing a whole lot over the course of the last couple of years. But a company that PayPal hired to mint and handle their stablecoin made a seemingly $300 trillion whoopsie. So for those like myself that might not understand all the ins and outs of how these things work and get created, how does a $300 trillion error get made on this front?
Yeah, it's astonishing. Paxos is the company that was minting this PayPal stablecoin, a cryptocurrency pegged to the dollar, PYUSD, competes with things like USD coin and some of the other big cryptos, back to the dollar. The problem was, they just digitally printed, and it was a mistake, $300 trillion. Obviously, it shouldn't have been that much. And, the good news, if you want to call it that, is that in a relatively quick fashion, about a half hour, Paxos was able to undo this mistake and burn, as the case would be, taking these assets off the blockchain so they no longer exist. They said that there was no security breach. It was an internal technical error. This is Paxos. So, it's a bad and somewhat amusing kind of headline, probably more for Paxos than PayPal. But
Sure.
PayPal, I think, got hit on it as well. And it's been a tough week and tough year for PayPal in general. The less amusing story, I guess, is, the Goldman Sachs downgrade earlier this week, which I wrote about.
So just to finish up on this, because a $300 trillion, fat finger error on a keyboard seems to run directly contradictory to one of the words that is used to describe these coins, i.e. the stable part of stable coins. And I guess before we move on, what does this indicate to you about the possibility of, errors like the one we saw, which, again, to their credit, was cleaned up within half an hour and didn't cause widespread issues. But I think of the possibility of intentional deception or fraud in this space, given how easy it was to accidentally type in a couple extra zeros.
Yeah, I mean, that's a fantastic question. I think that people who still remain skeptical of cryptocurrencies, whether it's Bitcoin, Ether, some of the goofier meme coins like Dogecoin, or these stable coins like the ones issued by Circle and Tether, the two giants of the industry, it does go to show that in some respects, it's still not all that difficult for technical glitches to happen. Clearly, it's not that hard to undo it in quick fashion. But I think the bigger concern is what happens if someone does intentionally, wind up, nefariously kind of hacking, the blockchain. And, I think that does lend, some credence to those who remain nervous about digital currencies and their security. I mean, I think it's a question that is outstanding, but I think, the crypto bulls would argue that this is still a safe and secure form of money. I mean, you have counterfeit paper currencies, you have issues with credit cards and debit cards. I think financial security is a problem for the broader monetary food chain, if you will, all types of currencies and not just crypto.
All right, so back to PayPal for a moment, not to kick them while they're down, but plenty of long-term shareholders will recall that not so long ago, 4 years ago, the stock was trading over $300 a share. Currently, it's sitting at $66 or so per share. Downgrade from Goldman Sachs, what did they cite as concern?
Yeah, Goldman Sachs obviously worried about inflation remaining a concern for consumers, as well as a weakening job market, which could be a problem for less affluent consumers using PayPal and Venmo and some of the other services. But also there's a lot of competition. You've got companies like Block, which owns Square and Cash App.
Sure.
I think the bigger concern would be, the competition from, Apple and Google, and Stripe as well, in the digital payments business. If you want to call it good news, Goldman did downgrade the stock to a sell, but the price target's 70, which ironically enough is actually higher than where it's currently trading. And the consensus price target is a little bit under $82 a share. So that does represent decent upside, but it's a mixed bag. I mean, there's a lot of analysts that cover PayPal. About half of them rated to buy, another half rated to hold, and there's a smattering of sells, including Goldman Sachs out there as well.
Paul LaMonica from Barron's joining us today. Talk a little bit about PayPal and a minor $300 trillion error that was made over the course of the last week. Paul, thanks so much for joining us. Appreciate it.
Thank you
Catch
very
next
much.
Week.
Appreciate it.
Taking a look here at markets as we close in on the noon hour, we've got the Dow and S&P in slightly positive territory, but have been bouncing all over the place. Dow up 0.33%, S&P 500 up just more than 0.1%, and the NASDAQ on the way down about 0.1%. So again, relative calm after a rough start to the morning, but we'll cover it all and more on Monday on the Financial Exchange. Have a great weekend, everybody.